Okay, so good morning, everyone. Thank you so much for the invitation. It's a pleasure to be here. When I was invited to participate in this conference, I was told to take a side, a CBDC side or a stablecoin side. And I said that I couldn't because I really believe that they can coexist. So my intention today is to give you some thoughts on how stablecoins and CBDCs are reshaping our society by solving different problems. Just a quick word about me. I'm Tamara. I have over 15 years of experience in financial market, and I started to involve myself in blockchain and the Web3 ecosystem in 2015. Currently, I am an executive director at the Digital Euro Conference, which is a think tank focused on digital money. And our mission is to be an independent voice of society committed to advance values such as privacy, freedom, and transparent governance in digital money space. It's also happy to connect with you. So on today's agenda, I will start with a brief introduction on digital money that includes a comparison between the old and the new money. Then secondly, I'm gonna touch on stablecoins around the world and show some famous use case for cross-border payments. I will do the same for CBDCs. And finally, I will finish by showing some ideas on how stablecoins and CBDCs can coexist. Okay, so with all that being said, let's start with the introduction of digital money. So if you have ever had an introduction to digital money, you probably are familiar with this image. This is the so-called money flower. And the curious thing is that since its creation, the money flower has just grown and grown. So for example, the private digital tokens, which at that point used to be Bitcoin and DIM, have grown tremendously, not just in the shapes and forms, but also in the value that has been moved over those payment rails nowadays. But let's focus on the digital dimensions of money we see here. So some of them are self-explanatory, but some might need some more explanation. So let's start with the first one, accessibility. So a money that is widely accessible, it's a money that it's only accessible for financial institutions like commercial banks, central banks, the governments, but also retail users, so private users like you and me. The second dimension, it's digital. So it's pretty self-explanatory. Obviously, commodity money, which is the gold, for example, it's not digital. Actually, you can touch it like the cash. But the cash is widely accessible and is central bank issued money, which brings us to the next point. So we have central bank issued money and non-central bank issued money. And the important point here is that only central bank issued money directly claim on the central bank. Otherwise, basically, the chain of commands is different and point to another agent in the ecosystem. So the money you hold in your banking account, it's a bank deposit and not a central bank issued type of money. The last dimension, it's probably the least self-explanatory, token-based. So for token-based money to be exchanged, we don't need an intermediary. So technically, if you are taking your keys and coins very seriously, and you don't have a crypto custodian, so Bitcoin would be a token-based money where you prove via a password or a passphrase that you have the right to move the money. So these are the four dimensions of money that are named here, and you can see this gray area that represents central bank digital money. So this is the CBDC, the public digital money. And the area that I mentioned at the beginning, so private digital coins, represent the private digital money. So as you will see, here you can see digital euro, but can be digital dollar or digital pound and other currency. But the digital money can have public and private issue sources. So stable coins would be issued by a private company, like Circle, for example. Obviously, they are not a central bank, but they have a bank license. And your bank also can issue a form of digital money as a tokenized deposit. And of course, that is crucial to say that digital money is different from digital payments. So again, the money you see in your banking account, it's not central bank issued money, it's commercial bank issued money. So banks hold liabilities in the same amount in central bank money in their balance sheets in the other side. So the money is central bank backed, but you don't have the claim. So the commercial bank has the claim. If bank deposits would be central bank issued money, you hold an account with the central bank and not with your commercial bank. Just a reminder of where it comes from. So it seems there are all these different types of money, but really if you break it down, we can see that the issuance sources are money of the state, so cash and central bank reserves, money of corporations, again, your banking account, and so on. And what I call money of people, that used to be the gold, for example. And in today's age, really, even though they seem more complicated, they still all have an equivalent in terms of the source of the issuance. So money of the state would be central bank digital currencies, CBDCs, money of corporations, stablecoins, and money of people, cryptocurrencies. Okay, so let's take a look at the stablecoin side. So stablecoins are a type of crypto asset designed to maintain a stable value related to a specified unit of account or store of value, such as national currency like euro, dollar, pound, or a commodity like the gold. And they aim to overcome some of the shortcomings of unbacked crypto assets. So particularly price volatility, and potentially make them more attractive as a means of payment or store of value. And stablecoins play an important role in the systems underpinning the trade and the use of crypto assets. So they are used commonly as a bridge to facilitate the trade between traditional currency and crypto assets, or even between different crypto assets. So 80% of trading on a selection of a large crypto exchange in 2022 has involved a stablecoin on one side or both sides of the trading. And of course that stablecoins also act as a safer store of value in the crypto ecosystem. Okay, but what happened? Where do we come from and where are we now? So over the last year, you can note the decrease in the total supply. Currently, we are at 126 million US dollars, below of the total supply of 2022. And we can see razor sharp very nicely as Terra Luna taking place, impacting 40 million US dollars last year. And it's impressive, I think, to be able to trace that back in this graphic. And in the meantime, stablecoins have started to be increasingly used for cross-border transactions as a fast and cost-effective means of payment. So launched in 2018 by Circle, USDC has become one of the key drivers of growth in cross-border payments with a circulation of 50 billion US dollars. And in collaboration with the Stellar Development Foundation, Circle offers a modern and compliant solution for low-cost, real-time, and borderless payments. USDC, it's also utilized for liquidity. So ARF, Global Settlement Banking Platform, offer a short-term USDC loans of 1 to 5 days to licensed money service businesses and financial institutions. So the adoption of stablecoins, like the USDC, for example, has the potential to reshape society by revolutioning cross-border remittances and B2B settlements because of the low-cost, real-time, and borderless payments. They can empower businesses and individuals, promote self-reliance and transparency in transactions without intermediaries. Okay, so let's take a look now at the CBDC side. And according with the CBDC tracker, more than 100 countries are exploring the topic, and at least 10 have already launched or have some kind of advanced pilot running. And the transition to Web 2 to Web 3 requires central bank money into the digital era. So the digital money would preserve the whole of public money as an anchor of payments in the digital age. So people need to have the confidence that private money can be always converted in central bank money. And apart from many advantages like faster, secure daily payments and improved financial system resilience, I'd like to highlight financial inclusion and access to payments, because I believe they are not addressed either by the current payment system or the stablecoin solution, especially when concerned offline capabilities. So financial inclusion entails access to appropriate and affordable financial services. And despite significant progress, we know that large parts of the world's population remain financially underserved. And CBDCs could potentially facilitate financial inclusion by increasing access to digital payments and thus serving as a gateway to wider access to financial services. All CBDC projects you see here have financial inclusion as a policy goal. The Eastern Caribbean, for example, the Sand Dollar project, consists of island nations where it has been difficult for financial institutions to develop economies of scale and find profitable channels of expansion. So foreign banks have increasingly withdrawn from the region, citing the low profitability. And access to payments, it's associated with, but it's not identical to financial inclusion. So even countries with high levels of financial inclusion, like Sweden, for example, can still face access to payment challenges. So Riksbank, the central bank of Sweden, has identified that the elderly and groups with certain disabilities as potential adversely affected in a cashless society. So while they are committed to ensure that cash will still be available and possible to use in the future, they are also exploring how CBDCs could facilitate the creation of digital payment, especially suitable for these groups as a complement for cash. So the adoption of CBDCs can potentially reshape our society by increased financial inclusion and access to payments. So we just saw that CBDCs and stablecoins can solve different problems and thus are likely to coexist in the coming years as a public and private actors developing new forms of money and payments. In some dimensions, of course, there might be a competition in different usage and adoption areas, but there are situations in which both types of money will necessarily have to interact. And I think that at the core of this synergy is interoperability. So the first level of interoperability is to make possible the direct exchange between stablecoins and CBDCs. The second level is the use of CBDCs as a collateral for stablecoins. So this could focus the role of the central bank and CBDCs as a trust and financial stability provider while leaving open private payment competition. And the third level consists in interoperability in payment ecosystem. So common regulatory regimes and similar programmatic interfaces would allow different services providers to interact with both CBDCs and stablecoins seamlessly. And this would, of course, enhance the network effect of both and their adoptions. I hope this gave you a good overview for the next sessions. Please feel free to reach out to me if you'd like to exchange ideas. Thank you for your time.